room. I'm going to let them in a minute. We've got 25 online at the moment. So what I will do is, if it's all right with you, Isabella, I'll let you start. I'll add people as we go along.
Yeah.
Okay, great. Everybody can hear me. Welcome, everybody. This is Isabella from Seed Legals. Her presentation, as always, was going to be fantastic and is well worth listening to, and I'll follow up with that later on as well. Thank you very much, Isabella.
Amazing. Okay, cool. So let's start from the beginning. Just so everyone kind of knows what we're talking about, today is everything to do with getting investment ready and getting funded. So what does that mean? Well, what we're looking at is the story of raising capital, right? So you start with the honeymoon phase of I have a brilliant idea and I'm going to change the world, and then you're actually faced with the task of getting that idea investment ready, and whatever that means, and then you actually have to raise investment for that idea, and then what are you meant to do once that cash is in the bank? So if we start from the beginning, right, when I speak to founders, the first thing I ask them is, do you have a founders agreement? And why is that? Essentially 10% of founders split up, and the problem with that is that if I own 50% of the company, and let's say Dave owns 50% of the company, and he leaves because COVID is hard and he's been put on furlough and he can't commit to something that isn't a sure thing, then he leaves with half the company. So half the company is not bringing in any new capital, it's not bringing in any new clients, right? You're uninvestable at that point, right? What investor will invest in half a company? And so what you want to have in place is fundamental stuff that protects you as a founder. So you want a founders agreement in place, outlining your rights and responsibility to the business. But what that does more importantly is it puts in place a share vesting schedule. So a share vesting schedule is I get 50% of the shares and you get 50% of the shares. But if we leave before, for example, 3 years, we have to give some of the shares back. What that means is if this time round Dave left and it's been a year and he's meant to stay for 3, he'd have to give 2/3 of his shares back. And so you want a share vesting schedule in place to protect yourself from your co-founder, and even if you're a solo founder. The reason being is that if an investor thinks you're serious, he's going to ask you, do you have founder service agreement in place? Do you have a vesting schedule? And if you say, oh, I haven't even thought about it, you just don't look that professional, and it's likely that your investor is going to tell you that they're going to impose a harsher vesting schedule on you of maybe 5, 6, 7 years rather than just 3. And along those lines, what you want to have in place is your intellectual property.
Mommy, ask Mama to do brushing.
Protecting anything you can patent, cancer or manufacturing and innovation, protecting your IP,
Yeah.
your design, right? Your logo, your trademark, your content. For example, if you hire a web designer, we have ideas about each website, but I've seen it happen before that no deal was really signed, or the deal that was signed, and then the
Excuse me 1 second, Isabella. There's somebody got a load of background noise here. Can everybody please?
Web designer came back and was like, hey, glad to see you're doing well. Funnily enough, you don't own the rights to your website. Give me 10 grand. And that's happened. Make sure it's assigned over to the company. So once we've protected ourselves as a founder, we want to start thinking about the SEIS and EIS advanced assurance. So for anyone who doesn't know what that is, you should. SEIS and EIS is essentially the tax scheme available to startups in the UK. So you can take up to £150,000 of SEIS funds where your investors get a 50% tax break, and you can take up to 12 million worth of EIS funds where your investors get a 30% tax break. So what does that mean? It basically means if it's between you and another company and you're able to produce an advance assurance form, you're able to show your investor you can give them that tax break, likely they're going to invest in you rather than your competitor, because even if they lose money on you, it'll be offset by their tax discounts. 98% of all early stage investment in the UK is funneled through SEIS and EIS. So if you don't have your advanced assurance form, which tells investors that you can give them SEIS, it's unlikely you're going to raise. So you have to have that in place. And it's similar, like if you're going to an investor going, hey, like, you know, super serious about investing, and then you don't even have the basics, you just don't seem like you're that far ahead. Now let's take a break here. So I've told you guys about founders agreements, IP assignments, SEIS, and you're probably thinking, that's great. Where am I going to get those documents? I can't afford a lawyer. And that's the whole thing. You don't have to. So everything I mentioned is free on Seed Legals. If you go onto the platform, you click quick agreements, you'll be brought something like this. Now I'm not giving you this. This would be a template. I'm giving you this, which is the terms that you want. And then we generate this, right? And so we're looking at all the necessary provisions, and that would be your contract sorted in no time. So we've protected ourselves as a founder, we have SEIS, and now I want to think about valuing the company. Now, do I have the method to value companies? What metrics you're going to be looking at? No, I don't. But do I have data? Yes, I do. So based on the 16,000 founders we work with and 3 years worth of data, we found that on average, founders raise once to 2 times every year, so not frequently, and they give away large amounts of equity. Now that equity is 15%. So per round, founders are giving away 15%. Why is that important? It's important because a lot of founders run the risk of doing the following. Oh my God, you want to give me £30,000 for 30% of the company? That seems like a great deal, and it's not. Because if you give 30% in your first round, what are you going to give in your second round? 20%? 15? Let's say you give 15, okay? And then in your next round, you give another 15. You've given over, right? Over half the company, and you've not even raised that much money. And by that point, if you have any like aim to raise with VCs or institutional investors, they're gone, because you've diluted yourself as a founder to the point that, do you have any skin in the game, really? And there's not enough equity for them to actually invest in. So now that we know that the benchmark is 15%, you can say, okay, well, how much money do I need, right? How much money do I need? How much do I need to get to the next year, plus 3 months of buffer? So do I need a website designer? Do I need an intern? Do I need AWS credits? Do I need an office space? What do you need? And then you're like, okay, how much equity do we want to give away? Ideally less than 15%. And that gives you a really nice benchmark to obviously not undervalue yourself, but also don't overvalue yourself, because it'll become pretty clear whether you can meet that valuation very, very soon. So if you predict yourself at 10 million and within the year it doesn't look like you're meeting that 10 mil forecast, you're going to go through a down round, and that also makes you uninvestable. Cool. So we've spoken about protecting yourself as a founder, we've spoken about SEIS, we've spoken about valuations and being wary of how much equity you give away. What about investors? What are you meant to say to them? What are tricks of the trade? So I think the first thing is you should always talk about a pre-money valuation. So why is that? Well, what is a pre-money valuation to begin with? Effectively, if I said, oh, the company's worth $1 million, because that's the number we've come up with, that's the pre-money valuation. If we're raising £250,000, then our post-money valuation, so post-investment valuations, is 1.25 mil, right? Now, what's the problem of going to investors and saying, hi, everyone, you know, super excited, we're closing at a 1.25 valuation? The problem is that until all of those documents are signed, nobody's actually given you the money, and that number can change. So I think lockdown was a really good example of simply how investors can pull out, right? Until that document is signed, investors can pull out. So if I emailed all of you and I'm like so excited to close our round tomorrow at 1.25 mil, and then one of you emails me and goes, hey, actually, I've got to pull out £100,000 and I'm left at 1.15, and I have to email all you and say, hi, actually, really sorry, we're closing at 1.15, then we have to change the documents, we have to update cap table, and you run the risk of losing other investors. So where you can maintain consistency, your pre-money valuation is a fixed target. So use that. Similarly, with investors, you want to have 2 decks. You want a short deck and you want a long deck. Why? Because if you start sending your most intricate financials out to everyone, you look a bit dumb, because loads of people now have your financials, loads of people can use them against you. You may have shared confidential information, right? And so for any investor that was interested in you, they may not be anymore. And any investor that was trying to screw you over, they now can. So how do you avoid that? Well, effectively, you have a short deck of this is us, this is why, this is how, this is what we do. And you have a longer deck of this is us, this is why, this is how, and these are our financial predictions, and this is our revenue model, and this is our business model, and this is what the next 4 years look like. Now, if a VC gets in contact with you and says, hey, you know, we love what you guys are doing, come sign a term sheet, don't just assume they're doing that because they have your best interests at heart, right? What they may be doing is their due diligence, right? And that's not to say you have to go to everyone and make them sign NDAs. That's not that. Just be smart. Like, do your due diligence on your investors. If someone's coming to you and it actually looks like they've just invested in a company of your size and type, they're probably not going to invest in you. Similarly, look at the VC's portfolios. What kind of companies do they invest in? Who's wasting your time? And I think that leads me really nicely to my next point, which is like, in the same way your investors do due diligence on you, do due diligence on your investors, right? So who are they? Who have they invested in? Do they actually have the money that they said that they have? If you go on Angel's List, like, can you see anything? If you go on Bohurst, like, you know, what was their recent LinkedIn activity? Who are they affiliated with? Because yes, it's true, like, kind of the more stuff you send out, the more likely you are to get responses. But with Angels, like, your best advice is the following: warm leads do better than any others. So if you know someone who's raised recently, whether a founder or an investor, get them to introduce you, because even though the person they introduce you to might not be right, they may know someone who is. Ask for advice and not for money. So if you email an investor, I don't know if Neil will agree with this, but if you say, hey, give me 50 grand, I have this great idea, it doesn't look great. Whereas if you're like, I actually know I saw you invested in all these things, you clearly know the area well, could you give me a bullet point on my deck? And then what happens is, you know, he probably will, or she will, smash your deck to pieces. But that's a good thing, because then in the next few weeks or in the next month, you can email them back and saying, hey, thank you so much for what you did. Funnily enough, everything you said, we actually disproved, and the advice you gave, we brought on, and suddenly you have a relationship. Sorry. So, you know, loads of little tips and tricks like that. And the final one is make sure your equity dilution is right. So your equity dilution is how much equity do your investors have? Like, how much does it look like? And that should be shown through your cap table. Your cap table is what is shown on the slides. It's the pie chart of ownership of the company. Now, if I'm an investor and I say, hey, I'm going to give you £30,000, what's my equity dilution? And you can't get the maths right, it just doesn't look good. But let's say you've closed your round. Congratulations, you've got someone to commit. That's amazing. What do you need to look out for? So although I could go take you through all the terms, I'm not going to, because we'll be here and it's a separate webinar that we do. But really what you're looking for is maintaining simplicity. So your share classes, you know, keep it simple. There's no point having the alphabet share class of A class and, you know, A shares and B shares and C pref shares and D ordinary shares, and that's nonsense. You want to create ordinary shares for when you incorporate with voting rights and dividends. Then you want to have maybe A ordinary shares for your investors that might be coming in on special provisions, and then, you know, B ordinary shares for your employees. But never ever create a share class where there's no owner of that shares. Like, don't create legacy shares just in case someone might join. Similarly, with your governance, be very careful. So whoever you bring onto the board, remember that they have a voting right. So if you guys don't align or they're not knowledgeable in your field, be really careful. In the same way, be careful about what you agree to come under investor consent. If the investor consent, which is basically investor veto, is too broad, you won't be able to do anything. And I think a really good example of that is a founder I was working with who, even to join an accelerator, even to pitch at an event, he needed permission, and that just becomes a huge bottleneck. So be really careful. And then finally, my final theme is know your stuff, right? Know the legals. There are about 12 to 15 provisions you need to know along the lines of preemption, drag along, tag along, anti-dilution, governance, share classes, share rights. And it's not hard. Like, all of it's online. Go on to see legals, go on to any of the other legal tech and sorry, I've been a bit ill recently, and any of the other legal tech companies, or talk to someone like Neil, you know, like, it's there for you. So going into this meeting being like, oh, I didn't know that, is not good enough. And if you get screwed over, it's your fault, to be honest. So yeah. Okay, now finally, something I want to talk about is actually how investment has changed. So previously we said, okay, founders are raising, you know, 1 to 2 times every year. They're raising really infrequently. They're giving away large amounts of equity. Why was that a problem this year? It was a problem this year because a lot of founders were aiming to raise in February and then didn't. And then they had runway, right? They had a runway. And then COVID number 2 happened, and we're in December and the market still isn't normal. So you can imagine how many people were in a position of, oh my God, we're going to go cash flow insolvent, right? Who could have predicted? And if you're in a sector like travel tech or hospitality or fintech, anything outside of logistics, mindfulness, educational tech, you're not in a good space. And so maybe you could raise money, but do you really want to go through a round? Is it the best time for your valuation? Probably not. And so arose the concept of agile funding, the ability to raise ahead of your round, go through your round, and top it up later. So what do I mean? Well, if let's say you meet an investor today and he's like, I want to invest in you, typically you say, okay, great, our round is closing in 2 months. Now you can say, great, let's close the deal. And what happens is they give you the cash. You promise them equity in the next round. There is a minimum and a kind of maximum valuation, but that's basically that. And it allows you to bring on this investor, give them a 10 to 20% discount on the share price when it comes. They benefit from SEIS and EIS, and it's a super simple way to get money in early. And it's a really fantastic way. A lot of founders have used bridge funding, right? Like, they didn't want to raise this year because this year has been, it is what it is. And so they got either existing investors or new investors to give them interim cash, right? Other people use this to start their business, right? Rather than going through a massive round, they just want to raise a little bit of cash. Great, you can do that too. So that's fantastic. And it's called an ASA or a seed fast, and it is the future of investment, this ability to not be constrained to, we have to close now, and if you don't, tough luck. And then the next part of that is topping up after your round. So let's say if we think about the example I gave on, you're about to close your round and then one of the investors pulls out, that's a big problem. And typically before, you had 2 choices: either, you know, hope for the best, keep your round open, maybe an investor will come and you run the risk of losing other investors, or you can close your round, right, and change everything and give away more equity and all of this stuff. And so now what you can have is something called an instant investment. And what that is the agreement that, okay, if we do not meet our target raise, we can continue raising with no permission. So it doesn't dilute your existing investors because they know what the raise is meant to be. But it just means that if you lose investors, or you haven't got everyone you want, or you don't like the investors you have, you can top up your round later. So what we're seeing is investors getting in money early, then closing their round, and then adding little bits after. Now, to give you a little bit of context, we recently had a seed fast, right, an ASA, so not a proper round, of £1 million. So don't think this is for 5K or 2K. It can be, but can it be used for bigger scale stuff? 100%. Now, some investors and VCs and family offices that I've spoken to will tell you, no, you don't want to go down that route. It messes with the financial predictions. It doesn't. They just aren't flexible in the way that they do stuff. It doesn't. Either you have no cash, or you raise with a terrible investor, or you're constrained to time, or you do it your way. I think you should do it your way. You're the founder, you know? So that's that. And then finally, what we're thinking about is, okay, we have money in the bank, and this is actually my speciality. what do we do with it? And you generally want to attract a cool team. Does that mean you should give shares to them? No, because that will incur tax. What you should be using is the EMI option scheme. It's the most tax efficient way to give equity to your team and also get corporate tax discount for the company. So if anybody has any specific questions on that, please let me know. That's my actual specialty alongside like larger fundraising strategy and the legal. So that's the presentation. I hope it was helpful. And if anybody has any questions, do let me know.
Isabella, thanks very much. Let me put my video on so you can see me. Haven't changed much. Well, maybe. So see, that won't work.
Do you want me to answer the questions, Neil?
Yeah, there's a couple of questions in the chat. I've got my funny little thing. Oh, there we go. And also, anybody who's got any direct questions for Isabella now, I'd suggest you, take advantage of the situation, because the knowledge that Isabella and Seed Legals have is invaluable, and you have the opportunity now to ask questions. We're not time limited on this event. We're here to help. That's the whole idea of it. Startups and raising capital. So please, if you want to ask a question, we had to mute people earlier. I think you can unmute yourselves now. And also just add one to the chat, and I'll turn that off for a second. Let me see if I have muted everybody or unmute everybody.
So the one question that's come up is, are certain business activities excluded from SEIS? And yes, yeah, there are. So if you're loaning cash, if you're taking on the cash for property development, if you're in oil and gas or mining, now, if you're in that sector, does it mean you're excluded? No. You could very easily be in real estate and be a software company. You could very easily be in oil and gas and be a software company. But if the activity you're carrying out is stuff like that, like to loan the money or to build something, it's not eligible. But most people are. And then if you're unsure if you'll be eligible, that's like why you do the advanced assurance, right? So that's that. And then there was a question about someone has been pouring money into the account, into the company to keep it going and paying the monthly costs. And you've put it as a director's loan, but should it be investment capital? I have not seen that. I think most people do put it in as a director's loan. To be honest, I'm not actually the particular investment expert. If you'd like further questions, go onto Seed Legals. On the bottom right, there's a chat button. Everybody assumes that's a bot. It's actually not. It's a direct line to our expert team that will put you in touch with the right person. So it might be worth asking them. But from what I've seen in the hundreds of founders I've worked with, people do tend to put it as a director's loan or a founder's loan, which you can claim back from the company when you raise investment, subject to your investors' consent. I'm currently, so that's that. And then how might you value a startup business pre-sales? Would the valuation at this point be fairly divorced from the sales fundamentals? So pre-rev, like I think the valuations don't actually mean anything. I think, you know, Neil may disagree, but you have no money. So what are you talking about? Like, should you size the market? Yeah. Like, should you see what other competitors are doing? Yeah. But really what you're looking at is how much money do we need and how much equity do we want to give away? And then when you've kind of got past that landmark and you actually start trading, right, and generating revenue, then it's much easier to look at your current revenue and then making a proper valuation and predictions. Because I think your first valuation doesn't really matter. Like the company's going to constantly evolve regardless. So focus more on how much money you actually need and the investors that you want, as opposed to what is our valuation. But if you guys, you know, do want a better view of getting a valuation or a financial one, you know, speak to Neil, obviously. But yeah, as you said, like it is contextual, different, like literally different sectors, different sizes. But I think if you're pre-rev, just focus on what you need. when is the first trading date defined for SEIS? So SEIS is when you actually make revenue. So trading is not incorporation. It's when you actually start officially trading your product. So if it's like friends and family, it's not, shouldn't be a problem. But when you make a commercial sale, like that would be trading. So my first customer, so you're telling me that you incorporated in May 2019, but your first customer was May 2020, but you understand, yeah, so you're fine. Incorporation doesn't mean anything. Some companies have been incorporated for 10 years and can still get SEIS. I think that's everything. I mean, guys, look, feel free to add me on LinkedIn and DM me some questions there if anything comes to mind. Or as I said, go on Seed Legals, jump on the expert chat. I think a lot of people that aren't customers of ours don't know that that's actually a very, very useful tool. So yeah. I think that's it, Neil. And I'll pass.
Right, I'm back on. I don't know what's going on today. Isabella, thanks very much indeed. Folks, anybody who wants to add questions to the chat going along, Isabella will be around, and she can answer them. I've put a little brochure up for today that's got Isabella's email and details on. We're recording this event. Sorry, let me put my video on, says he. We're recording the event, and what we'll do is send emails out to everybody tomorrow with a link to the actual video of the whole thing, so you can shoot backwards and forwards on it. That will come from our Dropbox account. I'd encourage you all, before I have a little chat with you later, to have a look at our website as well, which is exponential-events.com. Under the virtual events side of it, there's options, and I'll cover these later, to join our Angels investment group on LinkedIn, our startup companies on LinkedIn. We're all about building relationships between founders and potential investors, and that's exactly what we do with our events. I'll cover more of that later on. In the meantime, Dan, are you about, sir?
Yes. Hi,
oh,
Neil.
good. And you're unmuted. That's good.
Yeah.
I've muted everybody, and it's sort of got a bit funny. But right, I'd like to introduce you to Dan. Dan is a long-term partner of ours, and again, extremely useful contact to have for startups. Foresters are our IP trademark advisors, partners, sponsors. And Dan, if you'd like to take the floor, I shall shut myself up. Again, anybody, we're also doing a poll, so if you could help with that, that would be great, because it helps us understand the market, who's looking for what positions you're in as far as raising capital are concerned, whether you've got SEIS and such like, whether you're looking for IP advice. That helps everybody. It's anonymous, it won't be shared with anybody, so don't worry about that. Right, I will be quiet. Dan from Foresters, I'll let you take the floor. You should be able to share your.
Yeah, okay. Thanks, Neil. Thanks, Isabella. Hi, everyone. My name's Dan. I'm a partner at Foresters, and I'm going to talk to you today about how to get your IP investment ready. I'll just share my screen now. Okay, hopefully you can see my slides. So yeah, I'm from Foresters, and just moving on now, we're going to look at various forms of IP, and I'll be covering the three main ones, which are patents, trademarks, designs. There's other forms of IP which I'm not going to talk about today, but including copyright, trade secrets, and various other rights for protecting plants and databases and that kind of thing. So the best way to run through these IP forms is to look at some case studies, kicking off with trademarks. So a trademark can be registered to protect your company name, product name, slogans, graphics, symbols, that kind of thing. Here are some typical trademarks here. And the reason for registering your trademark is to stop others trading under your name and basically stealing customers by using your brand. It's really important to get this protection in place for your company. And I suspect a lot of you are early stage startups, so and you may be thinking of choosing a company name right now. If you're at this stage, it's a good idea to make your company name, make it distinctive so it stands out for obvious reasons. And also it's important that the name isn't actually descriptive of the goods or services that you're providing. And this will help increase the chances of you being able to register your trademark and get a monopoly on the use of that name. The good thing about trademarks is they last indefinitely, provided you pay a renewal fee, usually every 10 years. Okay, moving on to registered designs. Now, you can register the design of the appearance or the whole or part of the whole or part of a product. And this really protects the appearance of your product or your website and that kind of thing. And the requirements are that the design must be novel in the sense that it's not a design that's out there already, and the design must have individual character in the sense that it creates a different overall impression. Now these are pretty low bars to meet, so you can have slight differences in your design over what's gone before, and that will be deemed to meet the requirements. And the good thing about registered design protection is it's relatively quick and cheap to obtain. You can get an EU-wide design registration within one or 2 weeks. And this will give you a registration number which you can put on your product or on your website, and it can be a good deterrent against others who might be thinking of copying what you're doing. It shows you're serious about protecting your IP and you've got some protection in place. And a design registration lasts for up to 25 years if you pay renewal fees every 5 years. Here are some examples of what you can register. It's pretty broad: packaging, parts of products, also logos, computer icons, interfaces, so parts of your website, typefaces, graphic designs, basically anything that has a distinctive appearance that you want to protect. So moving on to patents. Now, a patent it's an IP right that gives you the right to stop others from using an invention that you've come up with. And a patent is your deal with the government or the rest of the world in return for telling the world how you're doing what you're doing. You can get up to 20 years monopoly to stop others from using your invention. And we have a first to file system, so it's really critical that you file your patent application before you disclose your invention to others, i.e. anyone outside of your business. And that's really important. Once the invention's out there, it's no longer possible to get valid patent protection in Europe, at least. So yeah, always file before you disclose, or use an NDA if needs be. And the requirements for patentability: the invention must be novel in the sense that it's not known already, not published anywhere. And the invention must be inventive in the sense that it's not an obvious combination of what's gone before. And also the invention mustn't be excluded from patentability. And there's a list of exclusions which includes business methods, mathematical methods, methods of treatment, and that kind of thing. So yeah, it's important to steer around those when you're drafting your patent application. And so, yeah, the route to patent protection: typically we'll file an initial priority application to get your filing date. This is your flag in the sand, if you like, from which your protection will run. And we typically advise filing a UK patent application first, because a UK application is relatively cheap, low official fees, and you can get a search report back from the UK Patent Office pretty quickly, within 3 or 4 months. And the search report will usually cites various documents that the Patent Office has found, and the Patent Office will say your invention's not new because it's disclosed here, or it's not inventive because it's disclosed in these combination of documents. And the search report will give you a good indication about whether you're likely to get a patent and what the scope of that patent may be, i.e. what protection you're going to get. So assuming the search report is favourable, and you want to go ahead with the patenting process, the next step would be to look at filing international patent applications. And you've got 12 months from your UK filing date in which to file in other countries. Now you could file in your key countries where you want protection. You'll need a patent in every single jurisdiction where you want protection. So your key markets, or your countries where you're manufacturing, that kind of thing. And it's pretty expensive to file these foreign applications. So a typical route for startups would be to file what's called an international patent application, or PCT application, in this 12-month window. And this will basically keep the door open for you to apply later on in almost all countries around the world. So it basically buys you another 18 months in which to decide where you want to file and where you need protection. So a total of 30 months from your original UK filing date. So that's how long you've got. You'll also need to raise quite a bit of capital to fund these national phase filings in the various countries. Okay, so yeah, here's a rather an old-looking iPhone, just to illustrate all the multitude of different forms of IP that subsist in this product. So yeah, Apple and iPhone are obviously registered as trademarks. The technical features and the way the phone works are protected by patents. The look and the look and the appearance of the interface and the phone itself are registered as designs. Copyright will subsist in the code, the software code, and Apple's going to hold some trade secrets back in the iPhone, things that it doesn't want to disclose to others and chooses not to patent. So that's a quick run through the main forms of IP. Now, what do your investors want to see? So first of all, are you going to get sued by somebody else when you launch your product? Has someone else got some IP which you're going to infringe? To check this, you can do a freedom to operate search. You can look at your competitors' IP portfolios. You can see what patents they filed. Make sure you've got a clear path to bringing your product to market. Secondly, have you protected what you're doing? Have you got an IP strategy in place to look at what IP you have in your business and your products and services? And have you worked out what you're going to file for, and get some search reports, work out whether your technology is actually patentable, and have a pipeline of IP filings, as I described earlier, filing in the UK and then other countries. So yeah, work out your key markets, where you want to file and what you want to protect. And finally, I'll just mention the patent box. This is a way of reducing your corporation tax payments, and it's possibly not so much of much relevance for an early stage startup that's not paying corporation tax, but further down the road, you can reduce your corporation tax by half, down to 10% on worldwide profits derived from a patented invention. So this can be a real tax saving further down the road. another reason to get your products or services patented. How can foresters help? Well, we can do free 30-minute consultations. I've been doing these by video over the last year, or we could do them in the office in London. Yeah, we can look at your IP and discuss what you're doing, discuss your business, and identify the IP which might be protectable. We can put together an IP strategy and set out a roadmap for you hitting your IP filing milestones and raising the necessary capital for the patent filings and trademark filings. We can also help you put together pitch documents for investors. We can help you with the IP section of that. And yeah, of course, we can give you fixed price quotes for filing your various IP rights. And finally, we can look at your competitors. We can do patent landscaping searches and look at what your competitors are doing and work out whether you have freedom to operate and do what you're doing. So sorry, there's a bit of a sales pitch here, but we've got a full team of attorneys here, patents and trademark experts from all fields. My background's electronics and software, but we've got a life sciences team and trademark and chemistry team as well. And I'm just going to end this with a quick run through of a bit of a success story. This is I don't know if you can see my mouse pointer, but this is a marking tool called the Marksman, which this chap came into our offices. He was a proper garden shed inventor. He'd been working on this in his garden shed. Literally, he was a builder and needed a way to mark out holes on a wall ready for drilling. So if you imagine you're holding up a kitchen cabinet and you've got some holes in the back, you want to mark out on the wall behind it some drilling points. So this is really difficult to do with a pencil. Apparently, the mark is never really accurate. So he developed this tool which sprays basically a chalk dust cross on the wall very accurately in exactly where you want to mount the drill the hole for mounting. Excuse me. So yeah, we helped him by doing a background search to look at what other similar tools are out there. We then drafted a patent application and filed it in the UK. He then went down the PCT route, filed an international patent application, and then ended up getting patents in all his key countries around the world: China, US, Europe, etc. We helped him register his trade name, the Marksman, in various countries. We also helped him do a pitch on Dragon's Den. We did a mock Dragon's Den in the office. He then went on Dragon's Den and he was offered investment by all of the dragons, which was great. He ended up not taking those in the end, but it was great exposure for his business. And off the back of that, basically, he's now stocked in almost all DIY stores across the UK. So yeah, this is an example of a success story and how getting the right IP protection in place can really help your business and help you get success. And that's it from me on the slides. If anyone's got any questions, I will stop sharing my screen now.
Yeah, hi Dan. There's a couple of questions in the chat at the moment. If you want to answer those, and also if anybody else has either got a direct question for Dan or want to put one in the chat for now, then feel free. I'll let you answer those ones.
Okay, thanks, Neil. So how long does it take to get a patent approved? Yeah, the patenting process is a long one, and it varies from country to country. In the UK, you're probably looking at around 2 to 4 years to get your patent granted. So what typically happens is you'll file your patent application, and it will remain pending until it's granted. And while your patent application is pending, that's when you can put patent pending on your product and literature. But it's only once you have a granted patent, i.e. after around 2 to 4 years, that you can actually stop others from using your invention. So yeah, so for UK, around 2 to 4 years. Europe, it can be longer, it can be 5+ years. In the States, it's usually around 2 to 4 years, same as the UK. So second question, how early should we consider trademarking? Is it useful for a pre-sales company? This is a good question. So trademark, unlike patents, it's not critical for you to protect your trademarks immediately, because you can seek trademark protection once you've got your business going, and do it at a later date. So I would say you should consider registering your trademarks once you've established your business and you know the name that you're going to be trading under, and you're trading already. That's when I would suggest. So, but yeah, feel free to drop me a line if you want any more information on that. I'll put my contact details in the chat box in a minute. So, okay, next question. Startups often change their logos or even brand names. Is it worth trademarking early? Okay, yeah, I think I'll refer to my previous answer here. So yeah, wait till you've settled on your logo and branding before you start filing your trademarks. So yeah, I would say wait, don't file too early. Okay, next question. Do you recommend DIY for filing trademarks, or should we use an agency or lawyer? Yeah, so there's a lot of services out there online where you can register your trademarks pretty cheaply. The reasons for using an agency or lawyer will be in that the lawyer will be able to help you draft the goods and services in the trademark application to maximize the scope of protection, because you need to protect your mark in the specific goods and services that you're operating in, but you also want to cover other possible areas which you may not have thought of. So you wouldn't want somebody else using your mark for a slightly different form of goods or services. And so yeah, so I would really recommend seeking advice, even if it's just an initial chat from a trademark attorney, trademark expert, in order to be sure that you've got the maximum scope of protection for your branding. So yeah, again, Foresters can help with that, of course. So do drop me an email. I think that's it in the sorry, one more question. For a startup operating in both the US and the UK, should we register for IP protections in both, and which country usually costs more? Yeah, so I guess what you're talking about is patent protection here. I mean, I would recommend starting in the UK first because it's cheaper, there's lower official fees. You can get your filing date here in the UK, and then everything runs from that filing date, whether it's the US or anywhere else. So there's really no downside to filing first in the UK. The US is much more expensive because US attorney fees are a lot higher than here in the UK. But yeah, I would suggest if you're operating in the UK, then UK is a good starting point. And like I say, there's no downside. Okay, I can't see any more questions. I'll paste my email address in the chat box if you want to drop me an email. But other than that, that's it from me. Thank you.
Dan, thanks very much indeed. Again, if anybody wants to contact Dan, he's going to paste his information now, and also a little, oh, hang on, okay, you've done that, that's great. Dan and Foresters have been invaluable to me as well, as because we have our own startup companies that we invest in, because we have an investment fund, and we've had conversations with Charlotte and Dan about various companies and IP options and such like trademarks that we're looking at as investors in our own right. And we also have, just so you know, all you guys know out there, we have investors on our book who will only look at people who've got some form of unique IP or a concept going into the market. It's an investment category in its own right. And obviously, if you haven't got it and you need it, people won't look at it. So I'd advise you as much as I possibly can to touch base with Dan. As I say, they offer a free initial consultation period and or meeting, which at the moment is obviously online, I'm assuming. It's going back into another sort of whatever it is, lockdown. But Dan, thanks very much indeed. Yeah. Right, now I'm going to try and share my screen. I've been having all sorts of problems. So you just bear with me for a minute. Okay, let's try that one. For those of you who don't know me, my name's Neil Davis. I run Exponential Events. We're not an event company as such. We're, oh, resume share, sorry. Let me try and get that up there. I'm trying to get. As I say, I've been having a few problems today. Shoot back up the top here. Okay. Maybe I'll do that way. Oh, that's a bit better. Oh, here we go. Can you see that? Right. So we've heard from Seed Legals, we've heard from Foresters, which is great. We're Exponential Events. That's our website, Exponential Events or exponential-events.com. We've been holding capital raising workshops, capital raising events, pitch events since 2017 in the city. We're renowned for being probably the best in the city. I'll say that myself, but we used to fill the Brand Exchange, which is just around the corner from the Bank of England, every month with 70 to 100 potential investors and 10 companies presenting. We've worked throughout that time with Seed Legals and also Foresters. I suppose getting more onto the nitty gritty of what we actually do, we help companies raise money, and that's exactly what we do. But we need them to be in a position to be able to actually be investable. You might come up with an idea. You think, okay, I've got a great idea. I'll set a company up, cost you 15 quid. I'm going to do this. Now, I'd flick down here first. And again, I'll share this little, this is more of like a thoughts presentation rather than an actual presentation, and a knowledge of both sides of the fence between founders and investors. Validate your concept first. The reason I say that, if I flick down here, is that the reason startups fail is they've got something, or they're trying to sell something, or a product or a service that the market doesn't want. 42% of all startups fail on that basis. Staggering amount, or staggering figure. Sorry, one sec. Here we go. Right. Rule one, this comes back to what Isabella was saying from Seed Legals earlier. And obviously there's a few industries excluded, but can be got around. And again, that's the importance of speaking to people like Seed Legals. If you don't have some form of SEIS or EIS, advance assurance tax breaks for your investors, you're going to find it extremely difficult to attract angel investors, such like. Yeah. I suppose the second thing that comes off that is that it's actually going to cost you some money to raise some money. Yeah, and you have to have that in your budget. It's not free. You know, you might have to go and meet an investor, assuming or when the actual lockdown and COVID gets over. Physically, you might have to fly to Edinburgh, or if you're in Edinburgh, you might have to go to London, or if you're in Wales, you might have to come to Manchester, whatever it might be. It's going to cost you money. So bear that in mind. I think Isabella mentioned a number of things. I think on the validation side, my advice is this. Get hold of your LinkedIn contacts, send them a teaser. I'd put a teaser in front of a short pitch deck. Short pitch deck would be 4 or 5 slides that you could present at one of our events within 3 to 5 minutes. The flyer which you could send out would be like, this is what we're looking at doing, this is how we're going to do it. Yeah. What's your thoughts on it? And this is part of the validation concept. You're obviously going to be extremely keen on your concept. You're going to fill your business plan or your pitch deck with slides and everything else. Investors won't look at it. What they want to know at an instant, because they get sent these things all day long, and so do I get 10, 15 a day, is, we'll cover the SEIS in a second. Page teaser, short deck. Basically, just go what you're up to, why you're doing it, how you're doing it, or you're going to do it, who you are, what you're actually asking for as an investment, and what you're offering other investors to come in. Yeah. The long one includes full information and everything else. Yeah. Now, I'm going to keep this relatively short on the basis that this is in the chat room, and I'll also email it to everybody out there. Once you've validated your concept, business, whatever it might be, you've obviously then got to get your legals in place, because if somebody then says, right, I'm going to invest, you go, well, hang on a minute. Okay, now I need to go and get shareholders agreement and all the terms of business and such like. So you need to have, once you've validated everything, this in place. Yeah, your trademarks, if applicable, insurance, key men, people and such like. The reason I say that, obviously, if you're a one-man band or one-woman band and the business relies completely on you, if something happens to you, God forbid, then the business is finished. So investors will look at that on the basis of, okay, if something happens to you, are you insured? Will I get my money back? Yeah. Obviously, you've got all the other business insurance plans and such like you can look at, and I won't tell you how to do that. What we do is work with companies like Foresters and Seed Legals on the basis of that we've got an investable company. Yep. So you've got everything in place. Oh, sorry about this. I'm trying to shoot down here. Valuation. Business valuation is a very tricky point. I'm going to disrupt the Airbnb market, which is worth X £100 billion a year, and we're going to get 0.05% of it. I'll tell you now, investors won't even look at you. Yeah, it's not something that they're interested in. Disrupting markets, this, that, and the other, and taking a percentage of it in a business plan or a pitch, it is not something that savvy investors will take any interest in whatsoever, which will make your valuation look ridiculous. They might come back to you and go, yeah, we're interested, but your valuation or pre-money or post-money valuation is just absolutely ridiculous. You know, you're worth nothing. You've got nothing. Yes, potentially you could be worth something, but be very careful what you're asking for, and also come back to earlier what Isabella said, what you're actually offering, because it'll just scare potential investors off. On that side, so many companies that approach us go, oh, we've been trying to get hold of VCs or private equity companies and such like. Again, VC market, unless you're raising over $500,000 and you've got something going, they're not going to look at you. You're going to just waste your time. Private equity funds, potentially you've got some chance, especially with tax advantage SEIS, CIS funds that will invest in early stage companies, which are quite interesting, and you need to approach those. So how do you raise capital? There's no simple answer. As I say, first of all, you've got to validate your concept. You contact all the relevant people you can through your social networks and such. Utilize every opportunity that's out there, especially nowadays online, because we're doing events. We've got people coming from Australia, the Middle East, Asia, the States, looking at potential companies to invest in. That's one of the advantages that's happened from COVID. It's made the world a bigger place online with Zoom and such like. So that's great. And also, you know, the general LinkedIn social networking things. Use other people other than ourselves. I'm not suggesting you just use us. We had, not last year now, obviously year before, we had 2,000 people actually physically attend, investors attend our events in London. We normally get now about 100 online for our pitch events. As I say, if you go to our exponential events or exponential-events.com website, you'll see our upcoming events. We're here to help and basically facilitate founders with investors to raise money and getting them the best possible position to be able to do that. We have our own investment platform, which is a closed-end investment platform. It's not a crowdfunding platform. It's whereby we can put a potential company looking to raise capital in touch with people who we know through our network who've already expressed an interest in, I don't know, a fintech company, a healthcare company, an ed company, whatever it might be. Yeah. And it enables us to put, you know, founder in touch with potential investor. You can look at crowdfunding options, they're there. Normally they'll require some form of investment, friends and family and such like, up to some of them maybe 60% before they'll put the deal on their platform. But it's there. We do, obviously, as I say, pitch events where we help companies, we put them in. We offer a set fee online now for like a 5-minute pitch to 50, 70, 80 people for £100. We'll follow it up, we'll video it. Investors can then get in contact with you. As I say, we've got an investment platform. Please contact me on that. If you go on to our website again and go under exponential events exponential-events.com networking, you'll see our LinkedIn groups. We've got an Angels group, which is exactly what it says. At the moment, I think there's near 300 potential investors on that. You're more than welcome to join that. Again, just go on our website. We've got a startups group for discussions, startups and such like to help. We've got a meetup group as well. That's, again, all on our website. I won't cover this one too much at the moment. That's our events when we hold them. Obviously, that's the platform. We're jigging that around at the moment. As I say, it's a closed-end platform. Again, if you want to put your company on there, either send me an email, which is at the top here. That's my own LinkedIn personal page, which you're more than welcome to contact me on. It's my mobile. Again, this is saved in the chat and will be sent out to everybody. If I flick back down the bottom. As I say, what we're here and our partners to do, you know, feel free to contact Isabella at Seed Legal. She can help you out immensely. As I say, the SEIS, EIS side of capital raising is vitally important. If you don't have it, you, to be brutally honest, you might as well forget what you're doing, because you're not going to get anywhere. You might get a few friends and family invest in something, but you're not going to be able to raise going forward. Dan from Forest has just mentioned, obviously, a free 30-minute call to discuss what you're up to with your IPs and such like if you need it. Again, vitally important. We charge, just say, £100 to anybody who's been on one of these events to attend or actually pitch at our events. We're here to help. That's the point. As a facilitator from, a company looking to raise, to put them in touch with potential investors, city professionals, angels that we know and such like. So that's it from me for now. If anybody's got any questions, please feel free to shout out or pop them in the chat. It seems to have gone up there and disappeared somewhere. Let me stop sharing that for a sec. Does anybody have any questions for me? Oh, okay, here we go. Neil, do investors attending your events who would do CFAST instead of a traditional round? Yeah, the funding options, I mean, for example, through seed legals and such like, have changed so much. A seed fast round, to me, if I was advising a company that I had an interest in, I'd go the seed fast route. Simple as that. The reason being is I don't have to set a valuation or set valuation. It gives me time to build my company before then going into an additional round. It locks the potential investors in at a profit. And to me, from the point of view of one, an investor, but two, also being a shareholder, a startup, is the way to go. Do you think in-person events are related to that? Hi, Mike. Yes, I do. I think you're going to get back, or hopefully we're going to get back into physical events. The advantages of physical events are that we know who's coming, we know who's in the room. We normally, let's say, we take over the Brand Exchange, which is literally 2 minutes walk round the corner from the Bank of England. We take over the whole club for the night. So we have bar, we have room upstairs that holds 70 to 100 people, packed. Obviously, we can't do that through social distancing rules and regulations, and normally 10 companies presenting. The advantage of that is I can introduce people directly. So I know that somebody's in the room who's interested in let's just say a fintech investment. I can say, Mike, come and meet Fred. Fred's interested in this. Boom, introduction, you're having a drink, relaxing, have a chat. Can be done online. I think the advantages of online are, as I mentioned earlier, it opens up the world. And I think you're going to see going forward a general hybrid of investment events like we do, whereby we will hold physical events, we will hold virtual events. And I say the advantage of virtual events is that depending on time, so we hold it, you've got access to the whole world. Yeah. Yeah. Hi, Jack. I think we've closed so far, or helped close so far, even in the COVID situation, we've had about 6 companies that we've had present at our events close their rounds. I hope that answers your question. I'll tell you a little story. I won't mention names on that point. I invited a couple of guys I knew, oh, it's back maybe 12 months ago or so now. And we had a company present at our event. And I had an ex-Goldman Sachs banker come. I had my friend who's a UK IFA come. The following day, I'm due to meet my mate in London at a club. So I turn up, there he is. Sitting next to him is the ex-Goldman Sachs guy and the guy that had presented at our event the night before. Yeah. Needless to say, the Goldman Sachs guy invested in his company and became a founder shareholder. So that gives you an idea of the way we work. Hope that helps, Jack. Anybody else I've missed or got any more questions? Okay. We've got a pitch event this Thursday at 6 o'clock. I'll share the link for anybody who's been on this Zoom. You're happy to have you attend to see what we do. Yeah, it won't cost you anything. I'm not saying you can pitch, but you can tune in, see how we work, see who's on there, and get some idea going into the new year where hopefully we'll break out from just virtual to a mixture of physical and also hybrid events, and that's what we're looking at doing. Any other questions before we close this one out? No. Okay, well, thanks for everybody for coming. Dan, again, thank you very much indeed. I'll speak to you soon. Isabella, and I think it's left, but again, thanks very much, Seed Legals. And if I can help in any way, please just say, go onto our website, check it out. We're here to help, and I wish everybody a very safe and Merry Christmas. Thank you very much.